This is episode 64 of the More Doors podcast. We have an exciting episode. We're going to talk about the Freddie Mac Multifamily Outlook report here in just a second. I'm here with my amazing co-host, whose locks are flowing today, Mr. Brian Force. We'll be back with our discussion and review of the report right after this. All right, everybody, welcome back to the More Doors podcast. It's our first episode of 2024. 2025.
Wow.
Whoa, sorry.
I know. It feels weird.
First episode of 2025. But we're back in action and excited for the new year.
It's good to be back, brother.
It is.
It's good to hear your voice in my headphones again.
Absolutely. I see you too much on Zoom and Teams and all that stuff, and it's good to see you
Likewise.
without a rectangle around your face.
Exactly. We're like real human beings again. And this is a real show. We're back for the new year. And first things first, we got to thank our sponsors. Make sure you check out deepbluere.com, the home of Deep Blue Capital. All sorts of educational content, great market updates, and information about our upcoming offerings and investment opportunities. So check out deepbluere.com. And then head on over and check out Tour Studios, TORE Studios.com, for all of your multimedia, podcasting, video creation needs. Jesse Showalter will hook you up over at tourstudios.com. What's up, brother?
Dude, life is good, man. Just got back from Mexico for a few days with my fiance. So that was awesome. And preparing for the next 5-month grind between now and the wedding.
Yep.
Got a couple of big work milestones in between now and then.
Love it.
Some asset management stuff going on, you know, back on the hunt for our next acquisition. All the things, man.
It definitely feels like we're back in the groove.
It definitely
The
does.
holiday season always kind of slows things down work-wise, which is good. It's good for a little reprieve, but I can't sit still for very long. So it's good to
agree.
feel like I'm back in it.
Absolutely.
Yeah.
Absolutely. Actually, you know, kind of abstract off-topic thing. I'm super proud. My daughter made honor roll at school today. So
Hey.
she did it last year. She did it this year. Today was like the halfway point of middle school. So
Congrats.
super proud of her, and hope she keeps it up.
Hell yeah, brother. That's awesome, man. Congratulations.
Absolutely.
All right. Let's dive in today, man. We are checking out the 2025 Freddie Mac Multifamily Outlook Report. A lot of good information here. You and I have both read it. We can't really put it up on the screen, but we will put this up as a link on our website later today. So by the time this episode comes out, you should be able to go and just download this as a PDF. But we look at this report every single year. It comes out in December for the next year. And this is basically a bite-sized chunk of what Freddie Mac thinks about the multifamily market.
Yep.
And I think the overarching narrative in this report, we'll dive deep on some of the things that are interesting to us, is that idea of survive till 25 might get pushed out a little bit longer.
Yeah. We have another saying about staying alive till 26, but this is a family show that we won't say it. We won't say it.
Yes. But it's as I think we have not only, not predicted, but have been discussing for a very long time, we're not going to see the variables that we thought would kind of snap back into place in 2025 from a rate perspective, even cap rate perspective, occupancy. Freddie Mac now seems to be really coming around to the messaging that this thing is going to take a little bit longer to unwind.
Yeah.
So I want to dive into some of the specific pages on this report, but I know there's a couple that I know that you really had your eyes on as well. Jesse, could you scroll down for us? Where was get this loaded up here?
I think this one was one of the ones that you and I talked about. But before we jump into Exhibit 1, right, it was very interesting about this report overall, because I kind of felt like in certain sections they just changed the 4 to a 5 from 2024 to 2025, where there's a lot of talk about how much incoming supply is really impacting the market. Overall, the absorption metrics continue to be very, very strong. I think we'll get into some surprisingly high areas from an absorption perspective. But I think I don't think anybody realized the extent of how long this incoming wave of supply would impact.
Yep.
And honestly, I think it still comes in over the course of the next 2 or 3 quarters.
Sure.
And I think that's going to keep a lot of the market fundamentals kind of in check.
I agree 100%. And so to that end, obviously supply affects occupancy, vacancy, whatever, and rates, rental rates. And so this first exhibit that we're looking at is basically a chart of the 10-year treasury.
Right.
And so it's really just looking at the last 6 months, basically, of where treasuries have been at, which affect rates and refinance rates and borrowing rates, everything that that is germane to deals, getting deals done. What's really interesting, though, is there have been 2 Federal Reserve rate cuts. And when we talk, or have been talking, all through late 23 and all through 24, through the first half of 24 into the fall, is whenever the Fed cuts rates, that's going to be good. Now we're going to start to see the rate cap premiums, escrow premiums, and rate cap renewal rates come down, because those things are really based on the market trends. So rate caps, the premium for rate caps has increased like 10x over the last 2 or 3 years. At least. Yeah. And so it doesn't necessarily mean that those premiums are going to stay that high and they're going to slowly come back down. If treasuries start to really fall, then renewing those rate caps, like the price will drop really, really significantly, really, really, really quickly. And a lot of people were expecting that. But we've had 2 rate cuts, one in September and then the other in November. Treasuries immediately increased both times after those rate cuts. And so the people that were underwriting deals with the Fed Reserve rate cuts in mind to be something that helped their financial fundamentals, they're not seeing that at all right now. And their rate cap premiums or the rate cap renewals are expensive. A lot of them are coming up. And now you've got the supply issue where that's going to keep the market in check, like you said, for a while. We're going to start to see that supply really come online here in the first half of 2025. I get that it's going to be absorbed, but is it going to be absorbed at rental rates that are going to keep these deals going that all of a sudden they can't refinance at the rate that they thought they were going to?
Yeah.
That's going to be really interesting to see play out.
I agree. I think there was a lot of aggressive underwriting and a lot of aggressive assumptions that just are holding deals back from being successful right now. I was on the phone with an investor in Florida just a couple of days ago. I think they were invested in 7 states. They have a 2013 asset in their portfolio, and the way they've been hit with occupancy, lack of rent growth, interest rates, all the things, right? He's like, I have to keep this thing at 99% occupancy to even break even.
Yeah.
Right? So you have one person who moves out, and now you're underwater. Yeah. And it's crazy.
Yeah.
Right. But what was interesting about this slide to me, this chart, is, some of my other partners and I, we closed a refinance the day before Thanksgiving. Okay. Like that Wednesday morning. And this was right around the time of the second rate cut. And it was weird. We were getting really psyched. We saw the Fed cut and then treasuries popped.
Yep.
Right. However, for whatever reason, we saw treasuries come down a little bit right before Thanksgiving. We were on the phone with the bond desk and locked in our rate. And then rates have gone up 50 or 60 bips since then. Yeah. Right. And so you think about deals that, were penciling at 4.5%. Maybe they were on a variable rate loan, right? Or one of these rate cap situations that, we've toured a number of those deals. Yep. It's hard to make those deals survive right now. It absolutely is. And that's, Jesse, can you do me a favor in the background? Because I think this warrants a little bit of a longer conversation. We were just watching me and Jesse's favorite week on CNBC is Davos week every year. It's just pretty funny. It's wild. Yeah. Everybody was wearing scarves. They get all dressed up. It's hysterical. We love it. We watched it in the office all day. Everyone's wearing leather gloves for no reason. It's so funny. But Trump was there today, did a speech at the World Economic Forum. And one of the things that he's continued to kind of his messaging has been rates are going to come down immediately. We got to get rates down, immediately. And I don't want to get into politics. I think that we made the right choice with the administration from the choices that we had. I don't believe that rates are going to come down, though. I just don't fundamentally believe when we're getting decent CPI
reports, and it does seem like the job market, from whatever measurable metrics they're using, is still improving.
Very stable.
Then why would you bring rates down and risk inflation going back up? So if you do, like I looked at this last night, I was having a conversation with one of our other partners, and you just do average interest rate during 1970, average interest rate during 1980s, average interest rate during the 1990s. You pull those up in like 3 different tabs. We are not in any, I mean, that's 30 years of data right there. And if you look during the 80s, it was, I mean, that's when the savings and loan. So that's pretty, that's, if just take out the savings and loan crisis, you're averaging 1979, the average fixed year, 30-year fixed mortgage was 11.2%. In 1990, through all of the 90s, the average 30-year fixed was 8.19%. So that's not as pertinent to multifamily, but it's still based off treasuries, right?
Exactly.
So it wasn't until the 2010s that we dipped below 5% ever. I mean, even through the early 2000s, it was at 6.29. So this idea that interest rates are too high at basically 6.8 right now, up till about 7.25, I just think we have decades and decades and decades worth of data that says that interest rate is pretty normal. Right. And if you're seeing good inflation readings, and it does feel like the labor market is hanging in there, maybe it's not popping, but it's hanging in there, I don't know why we keep parroting this idea that rates are going to come back down into the 5s.
Because it's society holding on to the last great, the time of existence, right?
Yeah.
But the data shows that we're not that far outside the strike zone, right?
No, not at all.
Do I think if inflation gets down to 2%, right, for a couple of quarters in a row, that maybe we see the Fed come in and do 2 or 3 25 basis point cuts? But I don't think that they're going to see, any one of us are going to see like rates come down as quickly as they went up and as significant a clip.
We have this idea that, yes, competition in the market could drive rates down if the Fed cuts rates. There's a big difference between the Fed overnight rate and the Fed funding rate, the Fed funds rate, and the treasuries, which is where the spread there is where your lenders are going to make their money. So if the Fed does cut rates and people are still able to get a job and they're still able to, inflation is coming down, so they're able to afford groceries and things like that, we got to have faith that all these lenders are going to decide that they're going to start to be the first mover and bring their rates down.
Totally.
That might happen. Mm-hmm. It also might not, right? Gas prices don't always fall when oil prices go down.
True.
It takes a market mover to be the first to do it. And so outside of a dearth of economic activity, I don't know that treasuries are going to come down. Even if the Fed cuts rates two more 25-point cuts, there's going to be a threshold where you have to bring rates down because people will just stop buying if they can't borrow. But the other side of this is also that it's not just rates, asset prices are super high. So I think the fear is if you bring rates down enough to spark more activity, that might continue to increase asset prices and make them unaffordable. On the single family side, this is exactly what we're seeing. This is where we're seeing, there's no two ways about it. We are seeing a stagflationary environment in residential real estate right now. High interest, high asset prices. And the problem that we're running into is the majority of Americans that are homeowners, their wealth is all tied up in their primary residence. And so it's not real wealth because right now, they can't sell because rates are too high. They have their 3.5% rate that they locked in 3 years ago. Their asset price has gone up by 40% in the last 3 years, let's just say. In some areas, it's even more than that. And so on paper, they've got that wealth. But if they were to go liquidate today, they would have to borrow at twice the rate, and they would have to pay a price that's 40% higher than what they bought their home for 3 years ago. So all that wealth would evaporate overnight. And so what happens is if you were to bring rates down, and you start to spark buying activity, you're buying at super inflated prices. We're just going to run into the same problem 18 months all over again. What has to happen is asset prices, especially on the single family side, have to come in alignment with wages. And rates are they're not a long-term, adjusting rates is not a long-term strategy to keep that economic machine moving forward. Affordability really comes down to wages and asset prices. And unfortunately, you're going to see a really long dry spell in activity in the single family space if asset prices and wages don't come more into balance. On the multifamily side, you're going to see the same thing with rental rates. Like, people have to be able to afford to rent at your complex. And you're borrowing, the rate at which you're borrowing, especially on these variable loans, is going to have a massive effect on what you have to charge to break even on that deal.
Right.
And if you're going to actually exit the deal at some point, you're now going to be competing against a whole lot of other deals that didn't go as planned. And that means that their asset prices are going to have to be adjusted so that they can liquidate those assets.
Right.
So it's a very interesting time to value real estate.
Agreed.
To try to find what asset prices truly are.
Agreed. And I think we were just talking about this before the show. I think there is a very quiet correction that people are hoping doesn't happen.
Right.
Especially in multifamily. Right. We've talked about interest rates. We've talked about taxes. We've talked about insurance ad nauseum. You take all this supply, and the amount of it is huge. And so we talk about absorption. What I would love to see, if anybody listening to this show has access to this data, let me know. But I want to see how much of that supply was absorbed at the pro forma rents that the developer originally expected.
Yep.
Right? Because right now, my guess is there's a very quiet race to the bottom, right, in order to put heads in beds in some of these developments. And as you put pricing pressure on incoming A-class supply, and the gap between A and B becomes that much closer, now you have residents from B-class communities moving up into A-class because it's affordable.
Right.
And now B-class needs to cut. So you kind of start to see this trickle effect. You know, we have a couple of assets in Arlington, and we haven't been able to raise rents, right?
Yep.
There's too much competition. There's some incoming supply, but that particular there's a lot of workforce housing in that area, and it's like if you raise rents too much, they're just going to go look somewhere else. Yep. You know, that $50 a month, that $75 a month, annualized $800 to $1,000 costs less to rent a U-Haul for a day and go move your stuff.
Yeah, you make that difference up in just a few months. And I think there's an even another kind of potent effect of this whole thing is renewals. So what we're seeing on one of the developments that we manage, and I see this in where I live, you lock in a rental rate for a year, and on your pro forma, you never expect that to go down. But what happens is we've gotten no less than 15 phone calls from people that were trying to renew at this development because we've had to drop rents on the vacant units. And every single one of those phone calls is, I'm only renewing if you drop me to the advertised price.
Right.
So you're losing money on the renewals as well.
That's exactly right.
And so it's not just your vacant units. You got to account for the fact that people look at the stuff that's available and they go, I mean, I did it, where we live at our Class A apartment complex that we live in. We got the rents reduced. My wife talked to the office and they're like, we see online that you guys are $150 cheaper than what we're paying right now, and they reduced it. And so it's really going to be interesting to see how all of those variables start to come into effect, because rates are staying higher longer. Rents are going to go down. Supply is incoming. It will be absorbed, but at what price?
Agreed.
And then where do cap rates go but up?
Agreed. Yeah. On this note, there's another chart in here. Jesse, if you wouldn't mind scrolling down a couple of slides, I'll let you know when to stop. Keep going. We'll come back to that one. I thought that one was great. Keep going. Keep going. That one.
Yeah.
Okay. So Exhibit 8 in this report takes a bunch of, big cities across the country and shows you what current occupancy is compared to the historical average. And all these major markets, or many of these major markets that are on this chart, have had an influx of supply.
Right.
And what's interesting, and I looked at Dallas, there's a lot of obviously sub-markets within Dallas, but there's like a 1.5 to a 1.7% difference between current occupancy and historic occupancy.
Yeah.
And so it doesn't sound like a lot, but when you're sitting down doing underwriting a deal and you're using historical occupancy, right, versus current occupancy, and you take that 1.5, 1.6% difference and you annualize it over your hold period, that is a major difference in your overall returns. And so like this slide to me was a very good reminder of using the most current occupancy and vacancy data, right? Don't look at historics.
Right.
Don't look at 10-year averages. Look at the last 6 months as all this supply is coming in. Underwrite it conservatively. As this supply wave comes in, and everybody, all the multifamily economists I follow say that 25 is, or 26, excuse me, is going, all the new supply is going to burn off, and we're going to see kind of hopefully the return to rent growth. But underwrite conservatively using these current occupancy metrics, and make deals work there. And if you get this, rent increase because of all the supply being absorbed in your year 2 through 5, better for you.
Yeah, it's gravy. But look at the trends as well, right?
Exactly.
Don't just look at historical data and think that that's going to continue forever. I think this is just a good overlying, a general point. We are in a very black swan type era in multifamily and commercial real estate right now. We are seeing the backside of a ton of deals being done with cheap money in a very, very fast forward moving market, and then a wild shift in variables. I truly think it's very possible that from peak to trough, you could see some asset prices decline by 40% from their 2022 highs. And I don't want to sound doom and gloom. That is just the reality of it. You know, those cap rates will compress again when supply gets absorbed, and over time, real estate will still obviously continue to increase value. But at occupancy levels that we're seeing, at the rental rate or rent growth numbers or rent shrinkage numbers that we're seeing in some cases, and then the outlook for rates, which I don't see a compelling case by why you're going to see a 2% drop in rates over the next 12 to 18 months. I don't understand why that would happen. You combine all that with underwriting that was done 3 years ago. This is a major black swan event that we're staring down the barrel of. And I just want people to understand that when they're underwriting deals right now.
Totally. We had a generational opportunity to deploy very cheap money, right? Lenders were super flexible. You had bridge funds come in hot and heavy, right? Even an agency writing 75, 80% LTV loans. But we're now looking at the exact flip side of that coin.
Yeah.
Right? I think towards the tail end of COVID, the governments came in and said, hey, we should be charging more for property taxes if everybody's buying these things, over asking, right? Appraisal waivers, all that sort of stuff. Let's go jack up property taxes in line with what people are actually paying for these things. And that hasn't been easy to back down. It's a very, very interesting time in the market. And I think, we probably have another 12 or 18 months of this. Like, I don't think the supply, this incoming wave of supply coming in at the end of Q3 of this year, and all of a sudden we're going to wake up October 1st, like, hey, it's back to normal.
Yeah.
There's so many other factors that need to work their way through.
The good news is, I say these things with a little bit of rosy lenses, because the best deals are done in these times. If you can raise capital right now, if you can tell the story the right way and you make conservative offers, I mean, the problem is there's not a lot of deal flow because there are so many deals that are on the rocks right now, and a lot of people are working with their lenders and financiers to try and figure things out. They're working on the tax side. They're working on the finance side. Like, they're trying to get these deals to stay afloat. And I commend that for sure. So it's difficult to get deals done right now because we're in a really, really difficult area where the bid ask is quite wide right now, because the ask has to still be high for people to even break even on their deals, because their operating costs have been so much higher than they thought they were, with insurance and taxes and all those things.
Everything. The price of a toilet.
Right? Yes, everything, right? So the ask is still high. The bid has to be much lower. So the spread's quite big. But that's not going to last forever.
Right.
The dam is going to break at some point. The lenders can only do so much to bail people out. On the tax side with like HCFs and things like that, you can only bail people out on the tax side for so long. in a general sense, we can only kick the can down the road so long. And so if you are looking to build your portfolio and get deals done, be patient, but you should be out telling the story right now.
Yeah.
If there's you get no points for burying your head in the sand and just acting like this isn't happening. You can really take advantage of what's coming down the road. If you're raising capital right now, if you're telling the story properly, at some point there are going to be deals that are falling in your lap.
Agreed. You know, it's interesting though, like the deals, we saw a bunch of deals come into our inbox a couple of weeks ago, right? And we were like, deal flow's coming, right? And we took a look at those 3 deals. One of them was off market, right? And, you know, very good, very solid operator that we know. I mean, we couldn't get it to pencil anywhere between 15% of the ask.
Yeah.
Right?
We've bought a deal from this operator before. So they're really solid.
Yeah, very solid. And I look at the performance of the asset on that 212. I'm like, if they're struggling with it, that says something.
Yeah.
Right.
Yeah.
And then we have another deal that we've underwritten that is publicly being marketed at the debt value.
Yes.
Right. So they're losing all their equity. They're just trying to get somebody to come in and take over the price of the debt.
Yes.
And then we have a third deal that, would love to figure out how to make it work, but they're hung up on breaking even.
Yeah.
Right. Where they pumped a lot of CapEx into the asset. It looks great, but did they over finish it for where the asset is? And now they want the buyer to absorb their mistakes. And when I look at their pro forma rents, I'm like, there's no way they're getting there. We own 4 communities inside of a 3-mile radius of this place. There's A-class assets that are barely getting their pro forma rents on a very clear C-class asset.
Yep, exactly. Well, you just hit the nail on the head with where the bid ask is they're hung up on break even.
Yeah.
And unfortunately, this is the part that is unavoidable to sound doom and gloom. People are going to lose money on some of these deals. This is the investment game. People lose money sometimes. To get these deals done and to get these assets back on track, they're going to need to be liquidated to another operator at a discount who can come in and get the deal back on track. And unfortunately, that's going to mean that investors are going to lose a little capital. Lenders are going to lose. There's going to be some short sale situations as well.
Yeah.
These assets have to transition hands. They just have to. And so, what's going to be really interesting to see is how that affects cap rates in a more general sense, meaning the deals that are operating well right now, those hold periods might need to be extended because their asset value is going to drop because the cap rate's going to decompress. And so even deals that are operating really solidly that might be on 5-year holds, those might need to get extended to 7 years to hit the returns that they were advertising through no fault of their own. Mm-hmm. It's just if you got 4 communities, and 2 of them get liquidated at a discount, the other 2, that cap rate goes up. They're not valued the same. You got to wait for cap rates to come back down before you can liquidate at the pro forma value that you were projecting. And so, it will be interesting to see how that ripple effect plays out over the next 5 to 10 years for these deals that are not going to sell and weren't going to sell until 28 or 29. Do those operators need to hold on until early in the 30s to hit those values?
Yeah.
That's going to be something that I think is going to be really interesting when it comes to future deal flow for some of those assets. It's going to be again, I don't want to sound doom and gloom. It's going to be very interesting to see what 25 and 26 bring as far as the unwinding of some of these deals.
Yeah.
I think it's just the writing is on the wall that it's going to get a little wild.
I agree. And I think when you think about this market through the eyes of a lender, right? Obviously, agency debt's one thing, right? But you have a lot of community banks out there that tend to be more flexible than agency. Yeah. There's a lot of bridge funds that lent out billions and billions of dollars, right? In 21, 22, 20, even 2023. We were on bridge debt. We had 2 assets next door to each other with the same bridge lender. And between when we needed to file our request for our last extension and when it was actually honored, like the entire staff changed at this company.
Wow.
right? They did like 1 or 2 reorgs inside of that couple of months. That's not normal, right? And that's just one lender. And so you may be able to kick the can down the road a little bit with them, buy yourself 6 months, maybe a year, but at some point they're going to say, you got to shit or get off the pot and we need our money.
Yeah.
Right. And how much of that is currently on, how many of those deals right now are currently on life support? And if you're, to your point, if you're in a position where you can raise capital and get some of those at an attractive basis, then I think there's going to be an opportunity. But I think you got to get past the temptation to go buy a deal that's in a distressed market, but the asset itself is not distressed, and you're just bailing out the seller.
Yeah, absolutely. That to kind of add to that, I'm just kind of getting this thought right now, is like the idea of who takes the hit. There are a lot of lenders out there that had a lot of money out in the form of bridge debt that is either has come due and now the refinance isn't going to make the deal work. And so the operator's kind of stuck. They've got bridge debt. They planned on refining. The refi rate is going to be way higher than they thought it was going to be. Or the asset just doesn't qualify for refi because it isn't operating well enough, right? They're just not hitting their marks at all. If those deals can't stay afloat, what happens when your lender can't stay afloat? And does another financier have to come in and gobble up that debt? And do they have to take it at a discount? And is that actually what ends up saving some of these deals, is some debt forgiveness, because a new lender is going to have to buy that debt for pennies on the dollar? And is that the way that some of this starts to unwind, is that some of these operators' deals are able to stay afloat because their lender goes insolvent and their debt gets bought for 60 cents or whatever it is on the dollar? And now they owe their new mortgage company way less than they did before. And now they still have a higher rate or whatever it is, but their debt has significantly decreased because they basically got gobbled up by another mortgage company for way less.
Yeah, I think that's a possibility. I tend to think that we're in such a competitive market right now that if anyone out there got a whiff of a bank that was in trouble, right, or a bridge fund was in trouble, that would get gobbled up and acquired pretty damn quickly, right? I don't think we're going to see the amount of distress that we saw back in 2008 in the banking community right now. I think there's still too much look at Bitcoin, right? Sure. There's still plenty of capital out there that, I think people are just waiting for the right time to deploy. I
agree. Yeah. I don't think you'll see the price of the debt fall that far because people will purchase it at way higher than 60 cents on the dollar or whatever.
And then I also think, and we've talked about this when like me, you, and Nick are underwriting deals, if you're able to, be unemotional about it and underwrite deals using today's criteria as opposed to what was a couple of years ago, you're probably in a pretty damn good position. Sure. If you can find deals that pencil right now, and you have conservative rent growth, perhaps zero in year 1, year 2, right? And you're able to not go into a deal with negative leverage,
right?
I think you can do pretty well over the course of the next 4 or 5 years. But it's all about basis and conservative estimates. Yeah. And the other thing that's really helping this, Jesse, I'm sorry, could you scroll up a couple of slides here? This was one that you and I kicked around a little bit. Now keep going. Keep going. That right there. Yep. Right. So on Exhibit 3 of the Freddie Mac report, it's got a great chart of what mortgage rates have done going back to 2020 and what multifamily monthly rent looks like compared to a mortgage. And in Q3 of 2024, the mortgage rate is 6.1%. which puts your monthly P&I on your average median sales price of $403,000, puts your principal and interest at $1,954 a month. So that does not include your taxes and your insurance, which are probably $1,000 a month.
Exactly.
Right? And the price to rent a multifamily unit on average in that same time period is $1,841.
Yeah.
So you're literally incentivized to rent right now.
Yep.
If you're, unless you're in a situation where you can go afford to spend $3,000 a month, right, on a home.
I mean, this is so true. And this is such a rabbit hole, but I think it's just such an interesting conversation. So the real flip here happened in 2021. That's where you started to see the in 2022. The big jump in the average monthly P&I between 2021 and 2022. It went from 1199 to 1821. It's just a 51.8 year-over-year increase. Just crazy. I mean, you guys remember that market. That was honestly, I mean, that's when our real estate sales team was crushing it, but it was not a super fun time to be in real estate because you just couldn't advise anybody. You're like, if you're trying to buy your house right now, I hope you have some extra money in the bank because we have no idea what the price of this house is going to be.
Before we hang up this phone, I want your agreement that you're signing an appraisal waiver, right?
Just everything. Literally everything, right? So
Jesse's nodding his head.
That's where it all flipped. You know, the multifamily monthly average rent in that year in 2022 was $1,749. And then again, right, you're not even taking insurance and taxes into the equation, right? I'm not paying taxes when I pay rent. So it became quite a bit more affordable on a monthly basis to rent. That trend has continued and continued. The interesting part about this, though, is that, okay, so now that feels like rents should start to increase because it's cheaper to rent, which means more people will opt to rent, which means supply and demand, rents will start to increase. Who are those renters is the interesting thing, though, because we are also on the precipice of like the biggest generational sort of retirement wave in the baby boomers happening. And this is where a lot of people want to unlock some of the wealth. They want to sell that family house that their kids grew up in because it's too big for their needs now. They want to move to either a smaller home or they want to rent an apartment. They want to unlock all that wealth that's stored in their house. And that's going to be a huge demographic of people that are looking to rent over the next 10 years. But can those people unlock that wealth? Can those people sell those houses to my generation or even Gen Z below me at the interest rates that we have to borrow at and the asset prices where they're at? Are they going to be able to unlock that wealth and become renters, or are they going to stay in those homes forever because they're not paying an average of $1,954 a month? They're paying $800 in their P&I.
Right.
If they bought it they bought it 15 years ago and then they refinanced at 3.25, right? Are they going to be as incentivized to liquidate those assets, unlock that wealth, and then become renters? I have no idea. They might just stay put. So that's going to be a really interesting thing to see happen. But then the other flip side of the coin is those kids that were going to become homeowners are now going to become renters. And will that drive rents up? So you have two really big generations of people that are in play right now. One that would usually be retiring right now and one that would usually be buying homes right now. They might not be buying homes. They might not be selling. Where are the renters going to come from? Yeah. It's a super interesting thought.
It is. And you I think we should check this out in between and now and our next episode is I wonder if the paradigm that you're talking about, it for sure exists. Do we see the rise of the reverse mortgage?
Yeah.
Right. Or if we were to look at data from 2015 through 2023 on how many, let's just aging homeowners that sold and moved to an apartment.
Yeah.
Do we see more of that particular age demographic passing down their home instead of trying to sell it?
Yeah.
And so it's less culture shock for someone in their family to go from renting to owning, because it's still you're inheriting mommy and daddy's payment, right, or someone in your family's payment, as opposed to a new mortgage, or do you see kind of the rise of the reverse mortgage where they start to generate income from their house and just stay in it until the end of life?
I think you're going to see both of those come into play in a big way. The passing down of homes is not something I had really considered before. That might keep the single family market frozen for a while. My parents are in their mid 60s. They have a lot of wealth tied up in their house, but they don't need to unlock it right now. They worked hard. They're in retirement now. They may never sell their house, and that might just become what the norm is that people hold on to their houses until they're paid off because they got a super low interest rate. They can afford the payments. They've got some passive income. Their mortgage is pretty much covered by what they make passively, and they have no incentive to really sell their home.
Exactly.
that's going to be really interesting to see how that unfolds.
So I think we're definitely, well, we're coming up on time, so we should start to wrap up soon. But I think we're definitely hitting the tip of the iceberg on this new normal.
Yep.
I'd encourage everyone, if you're interested in multifamily investing, you're an LP, go download this report. We'll have it on the site later today. It's got a lot of great nuggets in it. Very interesting to see, what happens this year with the supply and, can we start to see the return of more uniform rent growth rather than just sporadic? I think it's going to be a great year. It's going to be a very interesting year. I think there's going to be some shakeout and some fallout of marketers versus operators that we've talked about. Yeah. But I think it's going to be a good year.
If you are interested in being in the game as an operator right now is really the time to be telling this story, trying to raise capital, setting the tone for getting some deals done. Because like it or not, on the operator side, there's going to be deals at a distressed price to be done. And you can be one of those people that gets into a really great situation for the next 5 or 10 years by having the money ready to go now. When it's Murphy's Law. When it's hardest to raise capital is usually when the best deals are out there.
Exactly.
It's so easy to raise capital when everybody thinks that the gravy chain is going to continue forever. We're seeing the back end of that now. If you can tell the story right, you should be raising capital.
Absolutely.
Yeah. As we wrap it up, it's been a fun episode, man. I love talking about this stuff.
Me too. You did a good job today. And the hair is pretty sharp,
Likewise.
dude.
Thank you. I get like a couple of days in haircut cycles where it's not too short, it's not too long, and I feel pretty good at it. About it, and then it gets too long.
It's very Top Gun-ish.
Very Top Gun-ish?
Yes.
I'll take that.
Yes.
I'll take that. New Top Gun?
No, old Top Gun.
That's even better. Yeah. Old Top Gun's perfect. Classic. Appreciate you hanging with us today, guys. Go check out deepbluere.com. We'll have this report up there on the site a little bit later today, as well as a whole bunch of other educational content. And sign up and create your investor profile over there to get exclusive opportunities to be one of the first movers on our upcoming investment offers. And then go check out tourstudios.com for all your multimedia, video, podcast, content creation needs. TORE studios.com. We will be back now in the new year, weekly coming at you. Wednesdays, I believe, is when these get posted.
Wednesdays.
Yes. All right. I looked at you like you produced the show. Jesse's over there nodding.
Yeah, sure. Whatever you say.
Yeah, whatever. That's episode 64 in the books, boys and girls. We really appreciate you hanging with us. We'll see you next time.
Deuces.